Hi everyone, and welcome to our presentation, our webinar for out of Las Vegas this time. Before we get started, we want to apologize to everyone that our live streaming of the webinar, of the presentation that I gave at the JCK Talks, we ran into some technical difficulties and we weren't able to stream it live, and so we're doing a recording after the fact, giving the present so that we can give the presentation to everyone, and the recording to everyone that's registered for the webinar. So thanks for registering, and I hope we didn't take up too much of your time waiting for the presentation to begin. So here we are. We're in Las Vegas, and I'd like to start this presentation by giving doing a bit of an exercise. You know, when at the end of each year, as journalists, we run into a bit of a quiet period when it comes to the news coverage that's available to us. You know, in December, over the Christmas and New Year holiday period, many of the retailers are focused on selling their product. A lot of the trade is on holiday, and at the same time we've got to fill our news pages. So we need to be a bit creative in how we come up with stories that are not out there. And it's an opportunity for us to look back at the year and to see what happened in the diamond industry over the year. So we start to look at lists, you know, like the top diamonds that were the top 10 largest rough diamonds that were recovered in the year, or the top most expensive polished goods that were sold at auction on the auction circuit. Or we might look at you know, which stories, which Instagram or Twitter posts were most we got the most engagements with. And finally, one very powerful tool that sums up very nicely how the year was, or what the industry was thinking about during the year, are the most read stories that we have on diamonds.net, our news portal. And so I thought it would be an interesting exercise to at this, we're almost at the halfway point of 2019, to present what the most read stories on diamonds.net were, and that gives us a bit of a glimpse into what the industry is thinking about at this point of the year. So in terms of our top 5 stories, our number 5 was the story that the HRD grades its first lab-grown all diamond ring. That's shown on the screen. That's the picture of the diamond there. Number 4 was so far this year has been the lab-grown diamond that turns out to be natural. That's someone submitted a stone to the GIA. They thought it was a synthetic diamond, and so they submitted it for a synthetic diamond grading report, and it turned out to be a natural stone. So that garnered a lot of interest from our readers. Number 3 was that the GIA spots a natural synthetic hybrid diamond. That's a recent story that broke from the GIA's Gems and Gemology journal, where the GIA, someone submitted the GIA spotted what was a natural diamond that had a coating of CVD around it to enhance its color and to increase its size, and thereby trying to increase the value of the stones. And that's the second or third such stone that the GIA has identified. Number 2 was that Petra Diamonds recovered a 425 carat rough diamond from its Cullinan mine in South Africa. It's nice to have a non-synthetic diamond story in the list. And our top story so far this year is that the GIA aligns its lab-grown reports with the FTC guidelines. Last year, in fact, when the Federal Trade Commission updated its guidelines to expand the definition of just simply a diamond to include synthetics and to revise the or to advise against the use of the word synthetics. That was our top story for all of 2018. And so consistent with that, we see so far this year that this story that the GIA changed its synthetic grading reports to lab-grown reports was met with a lot of interest from our readers. So that's the top 5 stories. When we expand the list to the top 30, it gives us a bit of a more of a broader indication of what the themes are in the industry. And so half of the stories in the top 30, literally 15 out of the 30, were about synthetics. 5 were about large diamonds. That's either large rough diamonds that were recovered at the mining level, or big, beautiful, polished diamonds that were sold at strong prices at the auctions on the auction circuit. Provenance has been a theme this year. That we know there's a lot of talk about traceability and responsible sourcing in the industry, and so our coverage of De Beers launching its provenance program and the GIA unveiling a new diamond origin report was met with a lot of interest. Oversupply, we've spoken a lot on our webinars about the volume of goods that are stuck in the midstream, and any coverage of that has got us a lot of hits on our website. De Beers reducing its supply because of in recognition of its of the large amount of polished goods on the markets, and similar other stories that hit the top 30 list. And then there was a smattering of other topics that made up the rest of the top 30. I've chosen 2 here because I think they're interesting representation of what's happening in the markets. Dismantling the fluorescence stigma was a story that we ran in our magazine, and we decided to put it online, and we got a good response from that story. And then what online, similarly, this was a magazine story, what online jewelry influencers expect in 2019 in terms of design, in terms of what's happening in the jewelry space, was another one. And why I present this to you is because it really, when I saw this list, it presented, I got very excited because it really just sums up beautifully what's happening in the market. The talk of the town is no doubt synthetics. There's a lot of confusion and uncertainty about this issue. Retailers are wondering if they should move into lab-grown diamonds, if they shouldn't carry it, what the implications of it are. And there's just and manufacturers are similarly, the midstream is wondering if they can improve their margins or improve their turnover by moving into synthetics. And then they've got these beautiful large diamonds, and if lab grown is a controversial topic, the antidote is the beautiful large natural diamonds that come to the market and gain such high values, and really are testament to the value that is inherent in a natural diamond. Provenance is another response that the industry is kind of having to the synthetic, to the noise about synthetics, because the industry has realized that it needs to tell a better story. It needs to vouch for its product and show that natural diamonds have an ethical story, are responsibly sourced, are ethical, and have a do good story to tell. And then we've spoken a lot about this oversupply issue, and really, I think again, when we think about the energy that's devoted in the industry towards synthetics, it really clouds what I believe is the biggest challenge facing the market, and that is this the challenges in the midstream. You know, the liquidity crunch in the midstream, the lack of profitability, and the overall struggles that this segment of the market is having. And one of the contributing factors to that is that demand has narrowed. Demand for polished diamonds has narrowed. Buyers are much more selective in the goods that they want. They want a certain quality, and so we're left with a scenario where issues like no fluorescence, stones with no fluorescence would bring a premium and sell at a higher cost, a higher price to those with faint or lower quality goods. And then finally, there's at the end of the day, it's about what the consumer is doing. And so vital to our industry and individual businesses is to understand what trends are evolving in the market, not only in terms of economics, but certainly in terms of design. And understanding the design trends helps us to understand what goods are ultimately going to be moving at both wholesale and retail. And so that just gives a very beautiful snapshot of what's happening in the market, and something to be aware of. I think it's a valuable exercise to just in terms of our coverage, to understand what the industry is talking about. And so when we consider those themes, we outline our goals for today, and those themes paint a bit of a mixed picture, because there is a bit of a negative tone in the market, and certainly in the midstream. And I differentiate between the jewelry retailers, who I think in the United States there seems to be a relatively positive mood about them. About their businesses and their position in the market, in contrast to the midstream diamond industry, which is struggling. And so we ask the question for today: are we is this a critical point in the industry? Have we reached the crisis point? And we want to look at the data to understand to understand if we are in a crisis, both from a supply and demand and price point of view. The data will give us some indication of where we're heading for the second half of 2019. And finally, given this turbulent environment, we want to understand, how do we survive in this market? What do we have to do to grow our businesses in a challenging market environment that we find ourselves? And so far this year, when we look at the RAPI index, we're seeing declines across the board, and we're seeing particular weakness in the 3 carat and the 30 pointers, and the large stones and the very small stones. Which have our RAPI index for 30 pointers is down about 9.5%. Just over 9.5%. 3 carats is about 9.5% since the beginning of the year, and the 1 carat RAPI is down around 3%, and the half carats about just under 4%. I think it's very important, and I always bring up this graph in our webinars, to put it in context, because the downtrend is not an anomaly, and the overall trend has been downward since mid 2011. And ultimately, it's all part of a correction phase that we've been undergoing since the 2008-2009 financial crisis. So we ask ourselves: are we in a crisis? Is this, when we look at we've spoken before about the 10-year, decade-long changes that we're contending with. But what's happening in 2019 that just seems to add fuel to the fire, so to speak. So there are external factors and there are internal factors as always. Externally, we are facing a trade war, which I think is having an effect, at least on sentiment, and bringing uncertainty to the market. And there's some indications that the growth that we've seen in the United States economy over the last few years might be slowing, and that we're due for a slowdown in economic growth in the biggest market for our industry. Internal factors, again, there's a liquidity crunch that we're facing in the midstream, particularly in India this year. I think in the last year has seen an intensified liquidity crisis, and we're still trying to adapt to the changing retail environment that is so dynamic, and we'll talk a bit about that towards the end of this presentation. So to understand each point a bit more deeply, the trade war, as I said earlier, really is just fueling uncertainty, and when we look at the direct impact of the trade war on the industry, on the midstream, and it's really a sentiment play. We want that it just depresses the sentiment. People don't quite know how it is going to affect our businesses. Certainly, we know that the latest round of tariffs include diamond and jewelry imports from China to the United States, but really they're relatively small. China is really a relatively small supplier to the US in both categories. In diamonds, China accounts for about 1% of total imports of polished diamonds to the United States. So it's not enough to have an overall effect on prices and demand at the end of the day. But when we think of the trade war, we shift our attention to China, because China, we have seen a slowdown in Far East diamond demand. We're not seeing we're not feeling the Chinese buyers in the market as strongly as we have in the past. And we know that the currency, that the yuan currency has depreciated and been relatively volatile over the last year. A weaker currency against the dollar makes their diamond purchases more expensive, and therefore one would expect there to be a pullback in buying. And we've shown this graph before, but I think it's worth repeating that when we look at the 30 pointers, it's a nice illustration of the impact that the trade war might have had on diamond demand, because 30 pointers are essentially a Chinese product. When there's a slowdown in China for these goods, it does affect the global trade. And we saw at the beginning of 2018 was a good period for the industry, and coincidentally or not, in the very week that the first tariffs came into effect, the RAPI index for 30 pointers peaked, and we've been on a downtrend ever since then. And in the last almost a year now, this RAPI index for 30 pointers has lost almost 20%. In fact, it has lost about 20%, which is astounding. It's not purely a China play. You know, the other contributing factors, Indian liquidity, certainly being one of them, and we've spoken about these issues in the past, but I do believe that the trade war and the uncertainty surrounding it for China and for the Chinese trade has been a contributing factor to the downtrend in 30 pointers. In terms of the United States economy, it's worth noting that at the moment we're in a good place. Consumer confidence is up, unemployment is down, new housing sales hit an 11-year high earlier this year, and so there is an overall good feeling about the market. But there are certainly, at the same time, some expectation or some caution that is creeping into the outlook, and I think that's more about we may be not seeing it in the consumer confidence indicators, but we are hearing it from a CEO, from a management point of view, that there is some expectation that we're due for a slowdown. If you look historically over the last 40 or 50 years, the economy has slowed down on a 10-year cycle, essentially, and that's what I'm kind of showing on this graph, that there has been a recessionary period in over a 10-year period, every 10 years or so, and there's some suggestion that we are due for that in the next year or two. But for now, we're riding a positive wave, and that's been a catalyst for growth in the jewelry space. We're seeing consistent growth in the United States of about 3 to 4% of diamond jewelry and jewelry in general, and we're seeing pockets of very strong demand. The high-end brands like Cartier, Van Cleef & Arpels, Bulgari, LVMH are posting consistently around 10% growth each quarter. We're seeing that the department stores have invested somewhat in their jewelry category. Macy's and JCPenney, both which are facing generally a challenging retail environment. They haven't had stellar results, but they have mentioned that jewelry is a standout category for them. And then most encouraging for me is that we're seeing some strength in the independents, and it's not too long ago we were worried that the independents were going to be cannibalized by the strength of the major jewelers in the United States, and that's certainly not happened. In fact, the opposite. Today we're seeing that the independents have a good place in the market, a strong place in the market, and they certainly seem to be more flexible in adapting to the changes that have taken place at the retail level, and in servicing millennials who want that personal attention and personal interaction with someone they can trust. And from my viewpoint, the independents are able to provide that much more effectively than the majors. They're doing that also by embracing technology. The jewelers seem to be on a path towards greater efficiency. They're using technology to engage with their consumers through social media platforms more effectively, and also they're also investing in omni-channel recognizing that yes, consumers do buy jewelry online, or are prepared to buy jewelry online, as long as you give them the confidence and transparency of your product to do so, and using that omni-channel platform to drive traffic to their stores. Using technology again in their stores to enhance the jewelry buying experience. And so we're seeing more of that that sort of activity on the retail side of things, and I would expect it to intensify in the years to come. From a sourcing point of view, there is a feeling that jewelers are becoming more efficient in how they're sourcing goods. They don't want to be in a scenario that they were left with after the 2008 financial crisis, where they had inventory that they couldn't move. And they have it in their control not to hold that inventory. They're increasing their memo intake. There is a stronger interest in source verification, so they're more selective of who they're buying from, and the type of goods that they're buying from, making sure that they're responsibly sourced and are traceable, with many programs available to ensure that. And finally, again, they're tapping that technology in their stores so that they don't necessarily have to hold physical inventory to sell a diamond to the end consumer. And that again enhances the consumer's experience in the store. It makes for an experience. It plays into the experience economy that we know that we're operating in. But the result of that is that it adds to the struggles of the midstream, because if the retailers aren't holding stock, they're requiring their suppliers to bear that burden of inventory, and so the midstream is being squeezed by both ends of the market. The miners are maintaining high RIF prices. They're also requiring a threshold of demonstrated demand from manufacturers. In other words, that manufacturers, in order to maintain their long-term supply, are required to buy a certain amount of goods on a consistent basis. And so if they need to buy a certain amount of goods and the jewelers are not buying the same volume of goods, again, that's resulting in that oversupply that we've spoken about so extensively on these webinars. The midstream's also been put under pressure by the banks, or they're being squeezed by the banks, that have raised their compliance levels since the 2008 crisis, and still see the diamond industry as a high-risk industry. And in particular, in India, over the last year, we've seen the Indian banks join this trend, or this attitude that has been prevalent in other diamond centers like Belgium and Israel and New York for quite some time now. We're seeing the Indian banks also pull back their credit that they're extending to the diamond trade, and it's essentially because of that high risk perception. And the high risk perception is largely a result of the low profitability that is apparent in the manufacturing sector. And so the result of all of this is that we're currently in 2019 in a supply-driven market. The diamond industry should be a demand-driven market. We're a consumer product at the end of the day, and so prices should be driven by demand for the product. But today, in this year, it's really all about supply. And that supply story extends to 2017, when 2 or 3 new mines came to the market. And there was a spike in global rough production. That increased further in 2018. The gray graph the gray bar graph that you see is the volume of rough that's come to the market in carat terms, and the blue line is the value of that rough. We're expecting production by volume to come down by about 4% in 2019, but it would still be historically low when you look at the last 10 years. And that rough story has resulted in our now kind of famous or infamous graph of polished inventory that we see on RapNet, that over the last 2 years, the number the number of stones on RapNet has consistently increased. As that rough gets turned into polished, they need to move that polished, and we're seeing that that on RapNet. And today we're still seeing about a 20% year-on-year rise, increase of volume of stones on RapNet. And so at this point, I want to show you a bit about a new tool that we're going to be offering our research report subscribers as we move to a digital first platform and strategy at Rapaport for diamonds.net. That when we prepare the research report, and we've spoken a lot about this oversupply issue, but it's really evident in the data that we present in the research report. And the research report data is broken up between supply and demand and price factors. And so our business intelligence tool is designed to make the navigation of that data a little easier for our subscribers. So I'm going to just shift screens now to get to that business intelligence tool, if you'll bear with me for one moment. So I'm going to show you just 2 pages of the tool. When we're looking at demand supply factors, we look at inventory, and when we look at demand, we're looking at the sales that are going through the RapNet platform. So in terms of inventory, the supply side, we see here that these graphs show for 30 pointers across all colors and clarities. We're seeing that there's 75% more goods than there was last year. So that at the beginning of May, this graph is for, where the volume of 30 pointers across all categories was 75% higher than May 1st last year. We have a choice to present that in real data terms. So the black line then presents this year's volume of stones. There were 96,352 at the beginning of May on RapNet, and the green is the comparable figure last year. Just to look at 1 or 2 other sizes, the half carat is, and we'll wait for that to load. Is it loaded? Yeah, so the half carat is are showing an 88% increase over last year, which is quite significant. And the 1 carat is a bit more, as we've mentioned before, it's a bit more of a stable market, that we're seeing a 16% increase over last year at the beginning of May. So that's on the demand side. And sorry, we'll be, and you're able to see by country what the volume of stones that, so for example, in India, it's not surprising that the percentage sort of mirrors the overall picture. When it comes to the demand side, we're looking at sales on RapNet, and so there's a bit of a lag in the data, because we need 2 or 3 months of RapNet activity to recognize that diamond is not to recognize the sale, essentially. So these graphs present sales versus inventory on RapNet. So the green at the bottom of the bottom left graph shows inventory at the beginning of the month, new inventory that's coming, that's come to the platform, and sales volume would be the orange bar graph. And it's quite interesting because generally we're seeing that there's a correlation between the new inventory that's put on RapNet and sales. So which might suggest that the high volume of goods that are stuck in the midstream is really older stock, lower quality goods that are very difficult, that are difficult to move, particularly when you consider how the market has narrowed in terms of demand. The top graph gives the top left graph gives gives the total inventory versus sales, and what I think is a very powerful graph in terms of understanding where the market is the top right corner, where we show the percentage of inventory that is sold in the market. And here we see in the 30 pointers across all colors and clarities, and this is for RapSpec A3 diamonds. So it's essentially triple X goods and no fluorescence and faint and better quality goods. So the 22% of the stones are on RapNet were sold, which is, I think, a relatively low percentage for and not quite where we want to be in terms of a healthy market scenario. To look at some of the other sizes, the 50 pointers. With the 50 pointers, it's also in the low 20s, 24% in March of the goods on RapNet were sold, and of the 1 carat is generally a bit higher, but still not quite, I think, where we want to be. It was around 28% of inventory that was sold on RapNet. So it's a bit easier to navigate the data, but again, it just shows you where we're at in terms of the story of the midstream. That the midstream is struggling, and certainly in a different mood as we're at the JCK show. There is kind of there's a different sort of mood about the midstream versus the retail sector. And so how do we respond to this? How do we respond to this market scenario? And my colleague at Rapaport, Shimon Gerstensang, who is our head of trading and helps me tremendously to understand and present these webinars, alerted me to a fascinating graph that Thomas Friedman, who's an author, presented. And Thomas Friedman worked with tech executives to understand how understand how we're responding to the tremendous change that are taking place in terms of technology. How we're adapting to technology. And one of the tech execs presented this graph to him. And it says that human adaptability is generally a constant. It's on a slightly high, or let's say a gradual incline, but it's fairly constant. Whereas technology, in their case, and I would venture to say that the same applies to the diamond industry and all the challenges that we've faced. The change in technology has been exponential, but as long as the change curve is below the human adaptability curve, we are okay. We can cope with the changes. As soon as it's above it, it's not. It becomes more challenging, and so I believe that since over the last decade, we've seen that exponential change in the challenge in so many different spheres of that affect the diamond industry, whether it be how we market our product, how we have to market our product rather, how we relate to source verification, and the effect of the financial crisis on how we manage our inventory, the effect of technology on our businesses and how we do business, and the list goes on. And we've been with that as long as that change curve has been below the human adaptability curve. But where we are today is that the rate of change is well above the rate of our ability or our adaptability. And Thomas Friedman argues then is, how do we respond to that? Is that we've got to lift our adaptability. We've got to lift the human adaptability curve to meet the rate of change that we're dealing with. And so it's easier said than done. It's easier said than done, but it's certainly doable. And there are practical steps that we can understand the big picture and the big picture, what's happening in the market, and so how do we survive in this environment? And so I think there's some practical steps that we can take to ensure our survival, and I do believe that there are some interesting opportunities for growth that we can tap into, but there are practical steps that are essential, at least as a starter, to navigate this market. And the first would be that we need to understand the big picture. And where we sit within that big picture, what is happening in the market? We've got to be on top of these trends and understand what's going on out there. And we've got to do what we know best. We've got to understand what our role is within this environment. The second is to be flexible and open to change. We are that for so long, for so many generations, we did business in the same way, and if we're not going to and that's not going to work in this in today's world. And if we've got to take risks, if something's not working, be prepared to change and try something new and different. Our third point would be to adopt that corporate mindset that we've spoken about so often. And if the diamond industry was traditionally a handshake industry, that's not going to work anymore. We need to be transparent about our operations. We need to have the proper invoicing. We need to have the proper financials, and give and that's not only in order to please third-party service providers such as the banks or our suppliers of rough diamonds who require these steps. It's good for business as well. If you consider what is required to sell to inspire confidence for in a consumer who wants to buy a piece of jewelry online. The more information he has about the product and the company that's supplying that product, the greater confidence he'll have in making that purchase. The fourth point is that we want to make sure our supply chain is efficient, and that's on an individual business point of view. Is your supply chain efficient? If jewelers are increasingly only buying the inventory that they need for their operations, then why isn't the midstream doing the same? Why are we buying such amounts of rough? Or are you buying rough that you don't need, and is essentially just sitting in inventory at the for inventory that you can't move? And it's really one thing I've learned over the years in this industry is that it's not about, it certainly is about selling and how you sell your product, but equally important, and if not more important, is how you buy. Are you buying the right goods? The right goods that are going to add value to your business. Our fifth point is that we need to vouch for our product and make sure that this is a product that you would buy. And that's where we've seen some encouraging movement in the industry with these traceability programs, with organizations that are providing a platform to ensure that our individual businesses are on board in terms of sustainability and responsible sourcing of the product. And that's important because at the end of the day, it adds value to our story. It adds to the story that we want to tell, and this is a storytelling industry. Being able to say where your diamond comes from, the good that it's doing and contributing to society, helps us differentiate our product and our services in this crowded market. And there's certainly room for everyone to tell their story, because to avoid cliches, every diamond is unique, and I think every company has opportunity to find its niche and tell its unique story as well. Because at the end of the day, we want to provide an experience. We're working in an experience economy today, that consumers are looking for product and companies that are interesting, that are fun, that are sexy, and hold value. And I can't think of a product that ticks all those boxes as beautifully as a natural diamond. And I think we need to take advantage of that. It's just a matter of tapping into that energy of the product itself. So thank you very much for joining us again. Thanks for your patience around all the technical issues that we had in presenting this webinar. And our next webinar will probably be around July, after once the second quarter is complete. And maybe we'll look a bit more into the business intelligence tools, but certainly as we move into the second half of the year, understanding these data points is going to be crucial for our industry and for our businesses moving forward. So thanks very much for joining us, and I look forward to speaking to you all soon again.